What's up, Lab Coat agents? I'm Vanessa Noble, your LCA moderator out of Anchorage, Alaska. And I am really excited. I brought on one of our colleagues into this investment series. His name is Patrick out of San Diego. So for those of you that have any referrals or clients going to the San Diego area, I'm excited to introduce you to Patrick. And you can get a little idea of who he is and his business model and what he teaches. It's a little bit different from your conventional real estate sales, or I'll actually say it's a lot of bit different. And it's one of my favorite passions, especially as someone who champions investment strategies for military. Patrick is a veteran. He's a military Naval Academy graduate. So Patrick, why don't you share with our audience a little bit about, briefly what your military background is and what got you into real estate?
Yeah, sure. And thanks for having me on the show, Vanessa. So real quick, in just a couple of minutes, my background is like a lot of military folks. I grew up as a poor kid in the Midwest, and I enlisted in the Navy 2 weeks out of high school. Went to boot camp, 3 years enlisted, and then I got picked up to the Naval Academy. It took 3 years because they told me no 3 years in a row. And the fourth year, they said, no one's applied this many years, so you're in. I graduated the academy in 2007, and I served down here in San Diego as a surface warfare officer. In 2008, I bought my first property. It was a condo. Everyone told me I was an idiot. What are you doing? The sky is falling. It's 2008, big recession about to happen. And I bought anyway, because one of my senior enlisted mentors had told me, no matter what you do, just buy. Buy in good times, buy in bad times, buy in all times. And 2008, bought that condo, did a deployment, came back. 2009, bought my second condo. And I turned the first one into a rental. Did another deployment, came back. 2012, bought another property. 2014, bought my first duplex. And by then I realized I have more of a passion for real estate than I did for the military. Still love the military, so I stayed in the reserves. I actually hit my 20-year point, believe it or not, next month. And yeah, I know. Like half of it active duty.
I'm halfway there.
You're halfway there. Stick in it. So I just kind of combined investing in real estate with my military career on active duty. And when I left active duty, I realized if I want to make real estate my passion, I need some more hard skills in it beyond, hey, I've done a few deals that I bought myself. So I went up to UCLA, got an MBA with a focus in finance, came back down here to San Diego, went to University of San Diego and got a master's degree in real estate. That degree really does exist. They have masters in real estate. And thank you, GI Bill, because it paid for both of those master's degrees. And another little known fact for vets is your GI Bill covers 4 years of education, which equals 2 master's degrees. So if you already got your bachelor's, use that GI Bill. And in the last 3 to 4 years, I have started my own real estate brokerage, Patrick Capital Realty. I hang my license actually. So the brokerage I work under is Compass. Work under Compass. I've got my own team, to be clear, of 10 agents that I manage, and we're rocking and rolling every day. I also bought some more deals in the last couple of years. I'm in escrow on a fourplex right now. And once I close on that, I'll have about $6 million in real estate that I was able to buy all on my own, not syndication or anything, just all on my own. And the majority of that bought well on active duty. So it's definitely doable.
That's really amazing. And so when you went into, so you went into the reserves, you got your real estate license, you started a brokerage. What do you feel like set you apart in that investment space? Because our topic, we're going to talk about how we're, the positive and negative cash flow and where there's so many advantages when it comes to tax strategy and all that stuff. Mm-hmm. But when you got into real estate, what was your niche? Like, where did you find that niche, and what's kind of your competitive edge in the San Diego market?
Yeah, and I always say like the niche kind of finds you more than you finding it in real estate. And if you asked me 10, 15 years ago if I was going to be doing what I'm doing now, no way. Like it finds you, it bites you. One thing that obviously has to set everyone apart, and a lot of your listeners probably have this, is passion. If you don't just have the passion for real estate, and you're just hungry for money or something like that, you probably won't succeed. You got to have the passion. But after buying a couple of condos, a house, my niche that found me became 2 to 4 units. And the reason for that is because there was a little spell.
Hold on. I think we ended up dropping off of Facebook. Something happened that's never
put it back on.
Let me see.
I'm still watching on the group, or in the group, but the page is having difficulties.
Okay, cool. Because I'm looking at the group where it says Jake Fry's live, and it says the video has ended.
Actually, watching it, it literally just popped up as it ended right now. Let me see if I can go back live on Facebook. Hold on.
Maybe I was speaking too loud and it scared Facebook off. I don't know.
No, you're good.
Jake, you're not able to do it as LCA.
Let me see. We have to post it as moderators on my end. But sorry if this takes 1 second.
No, because I can go live. Well, I guess I'm not in the account.
Yeah, it has to be from Tristan's. I think we usually do it. We usually do this as a moderators post it. Hold on 1 second.
Sorry, Patrick.
No worries. So if we do anything where I present on the screen, I just share screen, right?
Yes.
Mm-hmm.
Preparing live stream now, and it should be back up in just 1 second. It's back on.
And also, okay, cool. So if you're just joining us right now, we just introed, so we had a little technical glitch here. Just want to intro Patrick out of San Diego. I'm going over kind of his niche in real estate, and I'm really talking about as a realtor where he started specializing in 2 to 4 units, which similarly is actually what I specialize in. Awesome. Here. You know, we have a lot of multifamily. So, and then, you know, San Diego is such an interesting market because it is really going to be an appreciation game in San Diego, which is kind of what we were, you know, what we're talking about today is that appreciation factor. Yeah. So, when you found that niche with 2 to 4 units, what is it that kind of became your wheelhouse that brought clients to you?
Well, my background before I got into residential was commercial, 5-unit and above apartment buildings. When I stepped over to residential, I learned quickly that most 2 to 4 units are brokered by residential brokers and agents. Yet at the end of the day, there's no difference between a 4-unit and a 5-unit other than maybe the lending being put on it. That said, I noticed a lot of errors in the MLS and the marketing of 2 to 4 units. Agents that were not correctly calculating or not at all calculating in advertising, the cap rate, the gross rent multiplier, the NOI, the real revenues, the real expenses. So when I noticed these discrepancies, for lack of better words, I capitalized on that and I said, look, like 90%, I kid you not, 90% of the 2 to 4 units being advertised on the MLS or any other way have errors and or blanks in the financials. I did a case study on over 200 properties. So I said, look, this is an inefficiency in the market. And if there's any way to make money in this world, it's to find a market that has inefficiencies and capitalize and become efficient within those inefficiencies. So my team, every member of my team, I teach them the fundamentals of real estate finance, and we ensure that we educate all of our clients on the fundamentals so that we and our clients can correctly underwrite all the 2 to 4 unit deals out there that are being misrepresented as far as the financials behind them. Everything I've personally bought has been on the MLS, and everything I personally bought, I find errors. And I tell every agent on my team, Our job is not to sell real estate. We have two jobs. One, educate the consumer, educate our client. And if you educate your client, you don't have to sell it because you're selling a good product. They'll want to buy it. Number two,
Right.
beyond education, our job is to find other people's mistakes. How do you find good deals? You don't find it by door knocking. You don't find it by sending out 5,000 mailers. You can find other people's mistakes right in front of you. It's the way Warren Buffett invests in companies. He just reads the financials of small mom and pop companies and large companies. And after reading the financials, he decides which one to buy. Warren Buffett does not knock on doors or send out 2,000 mailers. So I recommend all agents focus their business on educating and finding other people's errors.
Right. Awesome. And so going to that with your experience investing, you know, from an agent lens, because the crazy thing is a lot of agents don't invest. You know, they sell a lot of real estate, make a lot of money, and they don't make investing. So when I started to learn about even commercial syndication and real estate investing and the tax strategies and benefits there, I'm like, oh my God, if realtors only knew this is where they could put their money.
Yeah.
Yeah, it's like, what? You don't pay taxes? Huh? Say that again?
Yeah.
So that's, you know, been a huge, and there's so much to learn. So talk to me about, you know, the approach where your negative cash flow making you more wealthy than positive cash flow.
Absolutely. And this is the biggest misunderstood conception, or just not even understood conception out there, is that cash flow is king. It is absolutely not. And I start out by asking this, Vanessa, would you rather have $6.4 million or $2.3 million? It's an easy question.
It depends on the way it's taxed, right?
Well, I'll ask that question next, but would you rather have 6.4 or 2.3?
I can naturally 6.4. Okay.
Okay. Would you rather have $6.4 million not taxed or 2.3 million taxed at 35%? It gets even better. So you're choosing answer A, 6.4. So I can tell you right now, you're not a cash flow investor then. You might not even know that yet, but you're not a cash flow investor then. You're an appreciation investor. I've got a lengthy spreadsheet we don't need to go in right now, but it shows the story of person A and person B. Person A buys a $1.5 million multifamily that is an appreciation play, and they're going to negative cash flow their first few years. Mm-hmm. Person B buys a $1.5 million property that is a cash flow play, and it's going to cash flow like a king, but not appreciate as much. Person A is the one that ends up with $6 million in 30 years. Person B ends up with a little over 2 million. Why is that? So when we look at real estate investment, your return on your property is going to be around 9%. What do I mean by that? I'm talking about your overall return. Do you mind if I share my screen really quickly to exemplify this?
Absolutely.
All right.
Student mode.
Well, student mode. This is where I like to teach. And here's the question I just asked you. Excuse me, 3.5. We'll make that other choice even higher. 3.5. Okay. So let's talk about the cap rate misconception. I'm going to blow this up right here. Cap rate misconception. A lot of people think the cap rate is your rate of return. It's not. It's a portion of your rate of return. Your real rate of return is something called K. So in finance, and it doesn't matter if it's real estate, stocks, bonds, businesses, gold, your real return on any asset is K. K is just a constant used for all investment types. There's an economist, I think out of Princeton in the early 1900s, that came up with this formula. And K is simply your cash flow this year plus all of your future cash flows in the form of cash flow and appreciation of that asset. So in the stock market, you see at the bottom here, the formula is really simple. K equals your dividend plus your growth of the stock. So if you go out and buy a stock tomorrow, Vanessa, and it pays you a 4% dividend, your cap rate, your cash flow is at 4%. And if the stock also goes up in value 5% over the next year, you got a 5% appreciation on that stock. So your K equals that 4% dividend plus that 5% growth in the stock. Overall return 9%. The same applies to real estate. So in real estate, the financial formula we use is K equals cap rate plus growth. And this previous formula that I showed for stocks, we use that formula all the day on every exam when I was getting my MBA in finance. I didn't see it applied to real estate until I got the master's in real estate, and I saw the professor write this on the board. So what does this mean to you as a realtor, to your clients, and to investors? Break it down to what you see in front of you right here. You get different cap rates and different appreciation rates throughout the country. In the Midwest, we often see those cap rates around 7 or 8% plus or minus, but we also see lower appreciation rates. Because in the Midwest, if you want to build another complex or another neighborhood, you just go to the farmer that owns the field at the edge of town, you buy the field and you put up a neighborhood. In places like San Diego, San Francisco, New York, we can't do that. We have no more room to grow out and develop, which puts pressure on real estate values. Just like in a pressure cooker, it moves those values continuously up. There's about 50 fundamentals behind the economics of appreciation in markets like San Diego. We'll get into that another time. But when you look at these cap rates in San Diego, they're substantially lower than cap rates you're going to find in the Midwest and other secondary markets.
Which people that are superficially are looking at, just judging cap rates would say that that's a poor investment, or it doesn't, yield the correct return according to their
And I love your word superficially looking at it. And when you look at the overall return though, Vanessa, your return is 9%. There's a macroeconomic reason for that. If you invest in real estate from the West Coast to the East Coast and everything in between, your return is going to be about 9%. That's based off the spread between American real estate and the 10-year treasury. Again, that's another class, but just put this in your mind. Your return is going to be roughly around 9%.
You're looking at the statistically over time, this is what the average is going to yield.
That's right. And of course, there's going to be outliers. Some will have lower returns, some will have higher. But when you add up your appreciation plus your cap rate, it's going to be pretty darn close to 9 the majority of the time.
When you look at the difference on what is taxed versus what is not taxed, here we have a huge gap.
That's where you have the huge gap, plus the compounding effect of growth. It's, as Warren Buffett said, the 8th wonder of the world is compound interest. That growth of your asset is compounding year over year to make you much wealthier. And the one thing before I move off this slide is a lot of folks say, well, appreciation is speculative. I'll tell you what, appreciation is just as speculative as the sun coming up tomorrow. An asteroid could hit us and the sun doesn't come up. The world is destroyed. And same thing might happen and we don't appreciate. But if you go back the last 10, 20, 30, 40 years, the last 100 years, appreciation is all but guaranteed, folks. Go on.
As an Intel analyst, coming into real estate and I came, when in my early 20s, right before the crash, watching people buy on balloon interest loans, overbuying what they can afford. Even as a 19-year-old kid, I would say that doesn't sound like a wise investment. Like in 5 years, my income is not quadrupling that I expected. So I knew to stay out of that, the baited market in at that time. But the crazy thing is, so my generation is typically investment shy because we're afraid of a lot of these collapses of real estate and not knowing what to buy. So whenever I explain to people, especially after being an Intel analyst and applying that same scrutiny to real estate, and you look at market trends over time, from the beginning of our country, you're like, wait a minute. This is actually you can calculate this. Like for those of us that watch trends, we're not surprised that we're in a crash right now. Maybe I didn't expect that we would take this unprecedented, national or global dive, but we're right on track with the trends of a low point in the market. So, if you look from 2008 to today, that's what, 8 years?
Well, and to be clear, in San Diego, we're not seeing prices go down. In fact, we're seeing them continue to go up. San Diego real estate in a way is like toilet paper. It's not going to get affected even during a pandemic because of the lack of supply relative to demand. And we saw supply demand on toilet paper and Lysol and hand wipes go berserk in the last couple of months. And supply and demand on San Diego real estate just is a mismatch. We have 100 less units in San Diego, 100,000 less units than we need to meet demand. So we're actually seeing appreciation still in San Diego. My team put out 10 offers last week. Half of them didn't get accepted because of the multiple offer scenarios. Things are still getting bid up. Now, in those markets with high cap rates, that's not going to happen. You get a high cap rate not because it's a good investment. You get a high cap rate because it's a bad investment. A high cap rate, the appreciation is macroeconomic, okay? It's based on macroeconomics we cannot control. And that's a good thing. Cap rate is something we can control by selling properties for less money relative to the rents they get. So the way real estate investment finance 101 works is if we have a really good investment, it'll have a low cap rate because the macroeconomics of the fundamentals in that local economy are going to all but guarantee a return on investment from appreciation. If you have a bad market or a bad economy or a bad investment, you will get a cap rate, a high cap rate, because we have to artificially lower the price of the asset relative to the rents to ensure you get that 9%. In fact, in my hometown, Grafton, North Dakota, you can get cap rates of 12%. What's going on with that? Why can you get a cap rate above a 9%? Because when I was a kid growing up there, we had a population of 5,000. Now it has a population of less than 3,000. You have deflation, property values go down. That's why you have to have a cap rate above 9. So when I see someone bragging about getting a high cap rate, it tells me that they bought a bad deal most likely because they invested in a poor market that is not going to have all but guaranteed forced appreciation due to the economic fundamentals of the economy around that asset.
So let's talk about markets really fast since we're on the topic. You know, when I look at, I mean, in a lot of models, we look at the Walmart like inkblot model, right? And a lot of times this reminds me of military strategy, right? Where you look at the most dense, you know, populations and the infrastructure and the economic nodes in our country. I mean, when I was showing somebody where I believe like economy moves, you know, it's not a coincidence that you have San Diego, Los Angeles, San Francisco, Seattle, like in Anchorage, all of these port towns on the West Coast are import and export based economies, right? So when you're looking at markets, what are some of maybe the primary factors that are like your top three like points that you look at in a market to say this is a stable market or this is a market worth considering? Great question. And Vanessa, I'm glad you're asking because more important than the asset you buy is the economy you're buying into around that asset. A lot of people really, they underwrite a deal based on the deal. You need to underwrite it based on the economy around you. So the top three things I look at, number one, barriers to entry. And this is if you're investing in real estate or if you're investing in a business. You don't want to open up a hamburger shop because there's low barriers to entry. If you open up an airline, well, that's a weird example to use right now, but you're probably going to make a lot of money because there's high barriers to entry to opening an airline. You're not going to have a lot of competition. So if you invest in a market where it's real quick, easy, and cheap to build housing, you're not going to have much appreciation. And your rents are not going to go up that much over time. If you invest in a market that has high barriers to entry, pretty much anything in California because of the government regulations here, but specifically San Diego, which is landlocked, an ocean to the west, a military base to the north, a national forest to the east, and Mexico to the south. We have nowhere else to build. Hawaii, landlocked. Manhattan, landlocked. All these areas that have barriers to entry, you will get that forced appreciation. Alaska's landlocked.
Yeah, landlocked. Two, the economy. Look at the growing economic sectors in what you're buying. If you're buying in an area that is based on yesterday's technology, building cars, fossil fuels, that type of thing, you're going to be in trouble. You want to invest in an area that is based on tomorrow's technology because that's where you're going to find the economic growth. Look at what happened to San Francisco in the last 20 to 30 years. The silicon chip didn't just change the economy there, it changed the real estate prices because of the silicon chip. So in San Diego, we have biotech. You mentioned Seattle, technology. New York, heavily financed. You know, it's a big surprise. Pittsburgh. When you think of Pittsburgh, you think of steel, right? Pittsburgh has become a really big tech hub. And because of that, we've seen good appreciation in the Pittsburgh market. So invest in a city that has technology and an economy based on the future, not the past. And number three, a diverse economy. You do not want to invest in a city where 30 or 40% of the economy is based on one or two industries. If you're investing in the oil patch in Texas or in North Dakota, you're not speculating on real estate, you're speculating on oil, which is almost worse. So I always recommend buying in a market where no more than 20% of the economy is made up by any one industry. Now here in San Diego, no more than 16% of the economy is made up by any one industry. Technology, specifically biotech, makes up over 10%, but still not more than 16. Why do I like that diversity in an economy? Because it makes your investment recession resilient. You could have one sector of the economy hit the tank and you're still not going to be in that much trouble. You might think San Diego tourism, right, Vanessa?
Yeah, I mean, a little bit. I'm from LA, so I don't, San Diego is just another extended hub. Obviously, I see San Diego as like where people, migrated to or back and forth in between. But yeah, a lot of people would think it's tourism.
And as much as it is, only 10% of our economy is tourism. 10% of our economy is military, a little over 10% biotech. So you want to know the economy you're investing into. If you are putting money into a real estate deal and you know the property inside out, but you don't know the economy, you're fooling yourself. You need to know the economy you invest into.
Absolutely. Absolutely. And I love when you talked in that video of like, if we are giving advice to our clients about investing and not considering the implications of COVID to the economy, then, we're not making wise investment. We're not aiming correctly in the market.
That's right. And speaking of COVID, and a lot of times, again, back to that speculation, people say, Patrick, if you're investing for appreciation, you're speculating. And then I show them appreciation over the last 100 years. And there's not a 10-year period in American history where property is worth less than it was 10 years ago. Are there some ups and downs? Ups and downs, certainly. But over a 10-year period, we've never been worth less before. But what is speculative? A lot of people are finding out right now that cap rate is speculative because cap rate is based on rents. And when you have 15, 20% of the American renters not paying rent right now, look who's been speculating. It's that cap rate that is a bit more speculative. And I would rather bet my money on macroeconomic trends that one or two people can't control than rents that one renter can control.
Right.
So I would argue that appreciation is less speculative than cap rate and cash flow.
Absolutely. And it's been interesting to watch as buyers start to drop out of the market for the sake of, losing employment, et cetera, that when you are a multifamily investor, what is going to, right now we have this surge in buyers because people are, kind of grabbing at the opportunity to be able to invest. And then as that dips back down and we have buyers drop out, renters are going to be in a surplus because those that are not able, broke their qualification ability to get financed. Now, those that are invested in multifamily, I mean, their rents are going to, they're going to have a bigger rental pool. So it'll be interesting to watch this kind of wave as buyers shift in the market in the residential space.
That's right. That's right. And Vanessa, you mentioned taxes a little bit ago.
Yeah.
If you're going to be a real estate investor or a realtor, you need to know tax law. And I know that sounds boring.
I know,
last
I'm like,
night,
la, la, la.
Last night I was laying in bed.
You just be my best friend and tell me about it.
Sure, yeah. But no, like last night I'm laying in bed, getting ready to go to sleep. I'm reading a book and it's called Tax Law for the Real Estate Investor. And my wife looked at me and she said, "Are you reading that to fall asleep?" And I said, "No, I'm reading this because it's interesting. Like I love tax law."
Not everybody's like you, Patrick. Not everybody's like you.
Like you need to know it's not what you make, it's what you keep, as they say.
Yes.
So let's talk about taxes for a second and real estate, especially when it comes to investing, so we can advise our clients correctly. I always tell my clients, look, if you want to be wealthy, invest for cash flow. But if you want to be amazingly wealthy beyond what you ever thought you could be, then invest for appreciation. And the wealthiest Americans know this. The wealthiest Americans don't invest for cash flow. Trust me. They invest for appreciation because it is taxed completely differently. So I always talk about taxes being your largest expense, right? We learned that at the age of 6 playing Monopoly. You don't want to hit this. So let's talk about taxes for a second. And I'm going to ask you a couple more questions, Vanessa. I like questions. If you just made $80,000, Vanessa, would you rather pay 12% or 0% in taxes? Zero. Okay. If you just made $496,000, great year. Would you rather pay 35% or 15%? Probably 15. And last question, if you made $469K to infinity, would you rather pay 37 or 20%? If you choose green, then you are an appreciation investor. If you choose orange, you're a cash flow investor. You might not know that. You might not know why, but I'm telling you right now, if you choose green, you're an appreciation investor. So you look at taxes, and cash flow, Vanessa, is taxed as ordinary income. Ordinary income is the highest tax rate in the United States of America. And most of our clients, most of our real estate investment clients are going to be in these tax brackets at the very least, paying nearly a third of their cash flow to Uncle Sam. All right. Now, remember, your overall return is 9%. Do you want the majority of that 9% being taxed at this rate? Or do you want it being taxed at this rate? What you're looking at now is long-term capital gains tax rates. This is money that you make by not working. This is money that you don't make by cash flow, but you just make by appreciation. So if you buy that $500,000 or that $1 million or that $200,000 asset and you sell it years later, you got to own it for at least 12 months, and you're married filing jointly, you can make up to $80,000 tax-free. You can make up to almost $500,000 taxed at only 15%. And you can make over $500,000 on to infinity and get taxed at only 20%. Now, these are your federal tax brackets. I'm not going to talk state because state tax brackets are different for all 50 states. But let's talk what applies to everyone, and that's federal. That's why I asked you that series of questions. Would you rather pay about a third of that 9% to Uncle Sam? Or would you rather pay somewhere between 0 to 20% to Uncle Sam? That's your appreciation investor. That's why I always advise my clients, if you want to be as wealthy, more wealthy than you thought you could become, then don't give up a third of your return. Keep it all. And again, that appreciation is going to.
So many people care about this.
Yeah.
And so many people avoid this at the same time.
You need to know taxes and or get a really good CPA. And a lot of CPAs don't know real estate taxes that well because they might not own investments themselves. But this is powerful, Vanessa. It's a difference between, again, I did that case study. We won't get into the Excel spreadsheet. I built it a few weeks ago, but it shows two people buying a $1.5 million deal. And one of those individuals gets a 7% cap rate and a 2% appreciation. The other individual gets a 4.5% cap and a 4.5% appreciation. And after 30 years, when you look at all the cash flow through cap rate and you add that up, and all the appreciation, you add that up, the one that invested for cash flow acquired a little over $3 million over 30 years. And the one who invested for appreciation had a net worth of a little over $6 million over 30 years. And that is also because of that snowballing compound interest effect of your appreciation throughout time. The big thing too is, who is this? Do you know who this is, Vanessa? Can you see it? This guy's staring at you?
Yes.
Come on, History 101. This is Ben Franklin, our good old buddy Ben Franklin. And he said two things are certain in life. What are they? Taxes and death. Taxes and death, okay? However, I always like to ask a question.
A lot of quotes.
I love quotes.
Sorry, he said a lot of quotes, but I had to jump over because I was on our Facebook group.
No worries. No worries. But you know what? Ben Franklin wasn't alive during the 2019 tax code. Okay. And that 2019 tax code change eliminated taxes for real estate investors if you play your cards right. I'm telling you, Vanessa, you can make millions of dollars and not pay any taxes on it in life or after death, as long as you made that money through appreciation. Okay.
You know what's crazy is that, I often, and whatever you feel about him and Donald Trump, I'll just say his name while I say him.
Yeah.
When I'm teaching veteran investors who are looking at getting in the game, it's like the reality is that he's one of the largest real estate, investors in the world. And so, a lot of us that might have scrutinized him paying taxes or not paying taxes, and then you see this real estate tax law, then it's like, actually realtors are just not, like, we don't know the tax law, so we don't even know how to apply it to ourselves. So, I mean, that's another conversation, but regardless of what you feel about him as politically or as a president, as a real estate investor, I mean, let's be real. He's like one of the most successful real estate investors in the country.
I'm going to tell you right now, Vanessa, the tax law was written for real estate investors. The new tax law was written for real estate investors. No surprise. Look who the president is. Okay. And not only that, but it favors realtors in multiple ways. You now get the QBID deduction, which if you're a realtor and you don't know what the qualified business income deduction is, talk to your accountant. That'll save you thousands of dollars a year as a realtor.
Say that again. It wasn't clear. The Q what?
QBID, qualified business income deduction. So you know how C corporations got this huge tax cut? What about us? What about sole proprietors? What about S corps? What about LLCs? We now get a large deduction off of our income due to the qualified business income deduction that was passed. That's a whole nother 60-minute conversation, so we won't go down that rabbit hole. But if you're taking notes, you need to take the QBID deduction. Talk to your accountant. And the other great thing as a realtor is if you buy an investment asset, you can now accelerate your depreciation. We'll get into that in a second. And you can write that depreciation off against your ordinary income. So let me tell you a quick case study, Vanessa. You could go out and buy an $800,000 duplex or $200,000. I'm going to use $800,000 for this case study. $800,000 duplex. $500,000 is attributed to the building. Of the $500,000, $300,000 you can write off this year against your income. That's like putting $100K in your pocket by writing off that $300,000. I actually got some pictures that kind of show that in an illustration, if that would help. But if you're a realtor and you're investing, there are ways to pay very little to no taxes legally. We're not going to do it like Al Capone style and get tossed in jail, but legally not pay taxes off of all your gains. As you see up here, here's the 3 ways as a real estate investor. The first is capital gains, which we just talked about, taxed a lot less than income, i.e. tax less than cash flow. You can do the cash out refi. I just pulled $300,000 out of one of my properties. It appreciated. That's why I was able to pull that money out. Guess how much that $300K?
You have to know your cycle, right? You have to know your cycle when you're gonna time your. When I always talk to my brand new investors, so veteran uses a VA loan and they're like, I'm gonna pay off my property. I'm like, no, that's Depression era thinking.
No,
you wait for you ride the wave. You watch the cycle, you pull out your nest egg, and you reinvest the dollar.
Absolutely. So, do not pay off your debt, not your good debt. Pay off your credit cards, pay off your cars. Guys, I have never had a car loan in my life. I've never carried a credit card balance in my life. I have over $2 million in real estate debt. Like, real estate debt is awesome debt to have. And I just told you, if you invest in real estate, you're going to make a 9% return. So if you can borrow money at 3, 4, 5, 6%, borrow billions of dollars and then go invest it in something that's going to give you 9%. And you're going to make money doing nothing because you're borrowing it for less than the return you're getting on your investment.
I love that.
So yeah, of course, I just pulled out 300K. Did my mortgage go up? Of course it did. Am I going to use that 300K that I think I borrowed around 3% or so and go invest it in something that's going to give me a return 2 or 3 times that 3%? Of course. That's actually the fourplex I just opened escrow on. So you want to do that cash
fourplex is going to double the difference then, you know, or your position in the fourplex is going to double the difference of the cash flow that now the extra cash flow that's going out on your mortgage.
Yeah. And Vanessa, you're now going to be one of the people I quote because I like what you said. I like how you said depression era thinking. I don't know if you coined that term or not. Maybe I've heard it before, but I'll attribute it to you. And that is depression era thinking, or my mom and dad's generation. Okay. My mom and dad, probably your parents in the 70s and the 80s, interest rates were in the teens. Yeah. You don't want to borrow that money, but now that interest rates are as low as they are, go out there and borrow and invest.
Because, you know, a lot of the American dream started with buy a house, pay it off, and die there. You know, I mean, that's the American dream, not our dream, you know? So when you look at that, I need to buy a house and pay it down. I'm like, why would you sit on all that money doing nothing for you?
Absolutely.
You know? And so it really is that old school mentality of our grandfathers, you know, that went through the Depression and had this idea to pay off a house. It was like the closest thing that they could have to wealth because they were blue collar workers that went through, you know, I remember talking to someone who said that they used to split the gun wrappers just to hold the two, you know, or the toilet paper. And, you know, people that had that poverty mindset, you know, just want to hold what they have instead of really flipping the switch to where can I get education to support, you know, growing my investment. And this real estate, and as you love to teach veterans as I do, that when we take these simple principles and teach our buyers who start with owner occupied loans, even if it's not a military person, but starting with an owner occupied loan and learning how to leverage it so that they can get into this is really the path that we should all be educating our clients.
That's right. And Vanessa, like even I have a little bit of depression era mindset because of the way I grew up. Every car I own has been a hand-me-down. Like I've never bought a new car in my life.
I don't buy new cars either.
Yeah.
I don't believe in it. Used cars.
They're like 99% of what's out there in real estate, Vanessa, is misconceptions. It's bad information. Let's hit on one that you mentioned, and that's paying down your mortgage. The riskiest thing you can do is pay down your mortgage. Okay. Now let's answer why. Let's answer why. Let's say you got a $500,000 home and a $300,000 mortgage. And you're thinking, you know what? I'm going to put a little bit extra towards my mortgage every month because I got this extra money to pay it down faster. So I paid off in 26 years instead of 30. Okay. Probably not even going to own it for 26 years because the average length of ownership is 7 to 10. Nonetheless, besides the fact, let's talk about that person. Let's say that a tragedy hits. They get cancer. They lose their job. A spouse dies. You name it. Tragedy hits. And now those $500 a month extra payments they've been putting towards their house for the last 3 or 4 years is tens of thousands of dollars of equity in their home and not their checking account. And because they just perhaps lost a spouse, they no longer qualify to pull that equity out of the house because their debt to income ratio is all jacked up because they just lost one of their breadwinners in their family. So now you can't pull that equity out. You need the equity to survive and you get forced to sell. Okay. The other person who doesn't pay their mortgage off faster, and instead they take that extra money and instead of applying it towards their house, they put it in their checking account, put it in their savings account, put it in a CD, put it in an investment property. Okay. Something that's going to give you money or at least stay liquid for you. Money is much safer liquid, and it's much riskier tied up in an asset, even if that asset is your house. So maintain your liquidity. So if disaster hits your family, you've got the money in your checking account instead of in your house. It is so risky to pay off your house quick. It's also risky to get a 15-year mortgage over a 30-year mortgage. And if there's any doubt about the riskiness of a 15-year mortgage versus a 30-year mortgage, just look at the interest rate. Which one has a lower interest rate, Vanessa? The 15-year mortgage. Why does a 15-year mortgage have a lower interest rate? Because the bank is taking less risk. So the bank requires less return so they can give you a lower interest rate. Well, if the bank is taking less risk, who are they shifting that risk to? They're shifting it to you, the consumer, because you're losing liquidity and tying more money up into that equity every month.
Right.
I did a case study on this, Vanessa, in business school.
Most common sense. That's the most common sense thing that people don't look. You're like, oh, wow, why is the bank offering me a lower interest rate?
You're taking less risk. You're taking more.
Yeah. Yeah.
I'm telling you, 9 out of 10 common myths out there, and most of them see them as facts, but they're not, are nothing but, and I hate to be rude, uneducated misconceptions. Okay. And a lot of people in our industry share those misconceptions. But yeah, it's definitely risky to pay off your mortgage quickly. Keep that money in your bank.
And the thing is that these things are fed to us. It's almost like the way we do business in real estate. A lot of the things that our clients believe is because they were once told something when someone had an interest for them to believe it, right? Yeah. So like when we were told it's a better idea to buy the 15-year mortgage, someone told us it was a better strategy. So now it became a misconception. So a lot of times the way that we're served these ideas, is just, it's for the incentive of the person that's letting you borrow the money.
Well, and look, Vanessa, I always say I drink my own Kool-Aid and I practice what I preach. I never have and never will have a 15-year mortgage. I've never paid anything off early. In fact, I'll pay it off later because I'm doing cash out refis. On one of my investments, I have a 40-year loan because why not? So no, I practice what I preach. And I'm telling my clients too, that now is a good time to buy in San Diego. There's a lot of markets where it's been a bad time to buy now, and it's been a bad time to buy for a long time. And these are secondary, tertiary markets that don't have the economic fundamentals we see in San Diego and similar cities. But again, practicing what I'm preaching, I opened escrow on a deal I'm buying last week. I wouldn't be buying real estate now if I thought it was a bad idea.
Yep.
In fact,
and that's particularly in a strong market. So not in every market. So
not every
it's not
market.
like go buy, like, especially in more fragile markets, it's a little riskier to buy within the next 6 months, because in 6 months we might see better deals.
Look, in a more fragile market, it's always riskier to buy. Like, you shouldn't be investing in a fragile market 5 years ago, 1 year ago, or 5 years from now.
I mean, but if you live there, you can't help if you live in Vegas. If that's where you live, then you live there.
If you live in Vegas, invest in San Diego. But there's so many people that do the opposite. I see people take their San Diego money and they say, oh, San Diego's too expensive. And I'm like, oh, what makes you think it's expensive? So are diamonds, but there's a reason, supply and demand, okay? Right. And rocks on my sidewalk are pretty cheap, supply and demand, okay? And so many people would rather go buy rocks on my sidewalk because they think it's gonna cash flow more than a diamond. And yeah, diamond's not gonna cash flow, but it's going to appreciate much more. Right. Put your money in diamonds, not rocks. But
I love that you say that, because everybody thinks like real estate is unstable, and the reality is like, if you think about a diamond, the value of a diamond is very stable. The value of, those markets that are prime markets, they're stable, Yeah. And so when you just have perspective, I think so many people lack perspective. And I give this analogy, one time as an intel analyst here in Alaska, we obviously watch the skies, and there was a situation where there was a plane and everybody's like, oh my God, like there's a plane that's getting close. And you're like, yeah. And by the way, it is a training cycle. This happens every 3 years. It's actually normal, and there's no reason for people to like, start stockpiling their guns. Like it's fine, you know, but in a snapshot, in a small, you know, window of time, people can panic. And when you just have perspective on what you're doing, and I interview agents every day, and I had a new agent last year in Boston, and I told him the best thing you can do while you're getting ready to be a realtor is go research in your market what was happening 9 years ago, because maybe you didn't sell real estate, but if you can get the data that to arm yourself with that insight, then you can become an economic expert with what's happening in the trends of your current market.
Absolutely.
So putting it in context is so huge.
Vanessa, real estate is one of the most stable investments. When this pandemic hit, we saw gold prices go up, and we saw foreign investment in American real estate pick up 500% in March. Why? Because American real estate is one of the most stable investments in the world. During recessions, American real estate has gone up 3 of the last 5 recessions. So over half the time during a recession, real estate still goes up. And I think we're going to see that again during this recession. Again, very market specific. If you look at national real estate data, you are wasting your time. That's very important. I'll say that again. If you're looking at national real estate data, you're wasting your time, because real estate is so specific to the geographical location you're buying or selling in. Now to my market again, California, I was on a webinar last week with UCLA. UCLA's top economist, Ed Leamer, one of my professors when I went to school there. Ed Leamer, he's a doom and gloom type of guy. He does not sugarcoat anything. He's an economist, right? Now, when he talked about investments, he was very uncertain about most investments, but he did say the safest investment right now that he sees is California real estate. And that's because of the supply-demand issue. Well, everything is hitting the fan. He still sees, and we're seeing it play out in real life, California real estate is going to continue to go up. Again, supply and demand. It's the safest place to put your money. And again, like back to drinking my own Kool-Aid, Vanessa, the fourplex I'm buying is going to negative cash. I'm putting 25% down, and it's still going to negative cash flow $1,000 a month.
I mean, you have to be in the position to be able to cover that.
Well, so that's why I tell everyone the best thing you can have if you want to be a real estate investor is a good job. Like, so many people are like, oh, how do I get into real estate investing? Do I wholesale? Do I become a realtor? Do I door knock? Do I flip? No. If you want to be a real estate investor, go out and get a job, preferably a good W-2 government job, because that's what's going to give you the loans. Okay. Without a good job, you're not going to be a real estate investor. Go get a good job, start building up your portfolio. And as you said, Vanessa, once you get to a point that you don't need that job, then you can leave it, quit it. That's what I did.
Right.
But you got to be able to, eat that little bit of negative cash flow. But look, here's the thing, Vanessa. I just told you it's going to negative cash flow a month. I'm going to tell you right now, it's going to positive cash flow 120K in my first year.
Well,
because of cost
I want
segregation.
to use this model, okay? Because this is all like how, and I want us to get on again. You know, at least I don't know how long I can steal an hour of your time for how many weeks, but I would love to get us on a series, because there's so many concepts here that have to just be broken down a little bit more. Sure. And today we've had such a horrible time on Facebook. We're probably going to republish this Zoom, and just because the Zoom obviously stream is live and intact, so we'll probably push it. But Facebook has been horrible; it keeps dropping. Yeah. But what I want you to write, and I don't know if you want to share the screen and do the whiteboard so that you can actually I don't know if you ever used that, but
yeah, I've used it. Yeah.
If you are increasing your mortgage because you pulled out $300,000.
Yep.
So you are buying an asset that's going to negative cash flow $1,000. So what is the difference in your payment now that you pulled out 300 grand? That's like $2,000. Yes.
Yeah, I pulled out 300 grand. My payment only went up about 1,300 because I was already maybe like 4 or 5 years into my mortgage. I actually got a lower interest rate on my refi. But like, I mean, gosh, you just opened up a good rabbit hole that every realtor needs to know what I'm about to show you, because this will get a client to buy a house. And actually, I'm just going to write on my screen. So I'm moving the screen here for you. I'm going to write on it.
Okay.
My mortgage.
I see your whiteboard. Hold on. So then we need to take off the whiteboard.
You see the whiteboard?
I see the whiteboard. Are you going to draw on the whiteboard, or
We're going to draw on the whiteboard. Okay. Now, my mortgage is $6,500 a month. Okay. But I'm going to tell you right now, I get paid over $2,000 a month to live in my house. Okay. And this is why everyone needs to make their first investment their home. So why is that? So my mortgage is $6,500 a month. Okay. Of that, $2,000 is principal. Okay. So is that a cash outflow? No, it's a cash transfer. I'm transferring $2,000 from my checking account to my equity. My net worth doesn't go up or down. I still have that $2,000 to my net worth. So now that makes my payment, my cash outflow, really look like $4,500.
And there's the texting that you could type this too if you like that.
Oh, great.
Instead of a pen, you can
my
text.
Handwriting not clean?
Whatever you prefer.
So my mortgage payment after my principal is really about $4,500, right? So how am I telling you I'm still making $2,000 a month? Well, let me show you here in a second. If I'm making that $4,500 payment, of that, the majority is my taxes and my interest, right? Mm-hmm. Interest is tax deductible due to the tax code. Again, it goes back to the tax code. Your taxes I'm paying on my real estate, tax deductible. So let's say 4,000 of this is my tax deductible portion out of that 4,500. I'm in the 30-something% tax bracket. So that's saving me about $1,500 a month that I'm not paying in taxes now when I do my tax return. Does that make sense?
You're paying this interest.
Because
so it's paying your tax bill.
Absolutely. Mm-hmm. So when we take out that $4,500, that $1,500, make that a one, $1,500 that I'm not paying in taxes, my real monthly payment now is about $3,000. Okay. Does that make sense? Now in San Diego, this is a $1.5 million property. And in San Diego, we appreciate at about 4.5% per year. So if you take 1.5 appreciating at 4.5% a year, that's $5,600 a month in appreciation. And trust me, macroeconomically, I've seen that. I've lived in this house now for over a decade. Mark my word, it has appreciated over $5,000 month over month for the last 10 years.
Okay.
So if I'm really paying $3,000, but it's appreciating at $5,500 a month, how much am I really paying to live in this house? Zero. I'm getting paid $2,500 a month.
Based on appreciation, but not necessarily cash flow.
Based on appreciation, but not necessarily cash flow. Now, here's the thing, though.
For people
is that appreciation cash flow? You darn right it is. You just don't get it every month. But I've done 3 cash out refinances on my home. I have pulled out over $500,000 in the last 10 years on my house, all tax free. So we have this big misconception that cash flow is what you get every month. No, cash flow could be something that you don't get for 5 years, and then boom, all of a sudden $300K hits your checking account.
Right.
That's cash flow. And that $300K, if I took it as cash flow in the sense we think of, that would have been $200K, because a third of it would have been taken by Uncle Sam. But instead I use it as a cash out refi, or I take it as a capital gain. And I get that full amount, or a 1031 exchange, you get that full amount. You want to make your money on appreciation. Sorry, the whiteboard didn't work as good as if I was standing in front of it.
No, that's totally fine. So for example, if you are increasing your mortgage by $1,300 a month, okay?
Yep.
Then you're going to go on in this investment that is $1,000 negative each month. Yep. So you've increased your demand on your JOB, or your input to your day-to-day cash flow by $2,300.
Yep.
So where do you recover that money?
Good question. And beyond my down payment, I'm also putting in a little bit extra cash on the side to make the 25%, because it's well over $1 million bucks, this fourplex. My cash flow on this fourplex is going to be negative $1,000 a month. My principal payment is $2,000 a month. So when you look at your IRR, your internal rate of return, and that's really where you got to look at your wealth building, I'm actually positive $1,000 a month. Sure, negative $1,000 a month cash flow, but 2,000 of that is principal. So I'm positive 1,000. Plus, on this asset worth about 1.4 million, it's going to appreciate. It's 2 blocks to the beach, San Diego County. In that neighborhood, we're seeing appreciation around 4.5% to 5%. But let's be conservative. Let's just say it appreciates at 4%. And it's about $1.4 million. It's appreciating at about 50 to 60K per year, which adds up to about $4,000 to $5,000 per month in appreciation. So when you add in my principal pay down of $1,000 on top of that negative cash flow a month, plus about a $4,000 appreciation, I'm getting a $5,000 return on my investment per month. Okay, $60,000 return on my investment per year. And I'm putting down a little over 300K. A $60,000 return on a $300,000 investment is about a 20% return on my money. Nothing I would complain about. But back to the whole cash flow. People might say, well, Patrick, it still sucks because you're negative cash flow in a month, $1,000 a month. No, I'm actually going to positive cash flow about 120K in year one. How does that happen? I'm doing a cost segregation study. And again, Vanessa, cost segregation study, 60-minute topic. We can talk about a different time. But because of the cost segregation study, I'm getting a tax deduction this year of around $300,000. I'm in the 30-something% tax bracket. So if I get a 300K tax deduction, that's like putting 100K in my pocket, because now that's $100,000 in taxes I'm not paying. So there's your positive $100,000 and some thousand cash flow. A lot of spreadsheets, a lot of numbers behind it. But again, like that's how we teach our clients. That's how I work with my clients. That's how we make people millionaires. Yeah. In fact, I always tell people, if I make you a millionaire, I failed. My job is to make you a multimillionaire.
I love that. I love that. And gosh, it's just so cool, because this, to me, puts conventional real estate sales, turns it on its head. I just love for our real estate community to be able to learn some of these, more complex, advanced strategies and investment, because like as I interview realtors across the country building our active duty passive income network, and I always tell them I'm on a mission to build a network of the highest trained agents when it comes to investments possible, because we bear the responsibility that people are trusting us with their money, the money that they spend their life working to invest in, and if we don't like feel the weight of that responsibility as real estate professionals, we've failed utterly as an industry. And it's just so important that when we see anybody that is buying a home, when I call a realtor and they're like, I tell them, what do you tell a first time investor? And they start talking about investors. And I'm like, no, every buyer is making an investment. Yep. And if we don't just use those terms, you buy toilet paper, you buy a car, you buy, nobody ever says, I'm going to go invest in a vehicle. No, you do. Yeah. No, right? You go buy, there's things you buy, and real estate is what you invest in. And it's so important that we educate people. And these concepts are, mind blowing, because even as somebody that has sold a lot of real estate, and even always having that real estate lens since I started real estate, the investment lens, a lot of this stuff is just like, you're just not thinking about it because it's so layered in the way that money moves. That's right. So I really appreciate your level of knowledge. And I'm going to have you come on with our ADPI agents this week. And it was so funny. I'm like, so he's like a nuclear scientist in the Navy. What was your
when I was enlisted, I was in the nuclear power program in the Navy. So that was like 2 years of school. And then I'm telling you, the Navy has given me, I think, about a decade of school, all expenses paid, because I had 2 years of nuke school, a year at the Academy, Naval Academy Prep School, 4 years at the Academy, and then 4 years of grad school. So that's 11 years of education, all paid for by Thank You, Uncle Sam.
Oh my God, that's insane. Not everybody would put themselves through that much education.
Oh, I love it though. Like I read tax law at nighttime. So like that's.
I know, you just said that. I'm like, okay, so instead of, for those of us, your kindness and generosity when we spoke the first time of like, this information is useless if people don't learn it.
That's right.
And I'm excited to bring you to the largest real estate community on the planet. So Lab Coat Agents is the largest real estate community on the planet. And so you being able to have that platform to teach us something that not enough of us have the fortitude to read through is just super valuable. So, I know that I would trust you with my referrals, and I want to make sure that people know about your team and where you're at, and what you're passionate about. So.
Yeah. And our team, I mean, during the pandemic, my team is actually growing. We're doing more now than we did before the pandemic. And I think a good reason, you'll notice this in all industries, but those who are truly good at their trade are going to get more business over the next year. Those who,
yeah, absolutely.
And that's all industries.
As I was talking to some new realtors, and I'm like, this is a really hard time to come into real estate because you actually, you can't just sell people right now. You have to like educate them so that they feel like they're making a way, because everybody is, if they weren't already leery of you as a realtor, like now they're extra afraid, I'm going to make up that word, extra afraid of what's happening in the market. And so if you're a new realtor, it is very hard to come in, unless you're willing to just sell people anything, but to come in and actually like educate them on how to make decisions. So.
Well, and Vanessa, we touched the surface level of a lot of various topics today: 1031 exchanges, negative cash flow versus passive, cost segregation, all these things. And I teach a 4-session class, and most people pay like, I don't even know what they pay, like a few $100 to take the class. I'd be happy.
Those links you sent me?
Yeah, those are all links I sent you. And that's what I was going to say. I'd be happy to do it for free, like to fellow realtors and team members and clients. I'd be happy to teach anyone anything that they want to learn, because I just like to grow my network and share knowledge. And I really want to get rid of all the fallacies out there that cash flow is king. Here's the thing, like the same person that'll say max out your IRA, max out your 401k, in the same breath of air, they'll say, but God forbid you ever invest in negative cash flow real estate. Well, let's think about it for a second. A 401k, an IRA, they're all negative cash flow growth assets. You lose, if I put the max you can put in a 401k this year is like 18,500. Maybe it's 19,000. If I put 19,000 in a 401k this year, that's a negative cash flow. It's going from my checking account to my investment brokerage retirement account that I can't touch until I'm 59 and a half. And it's going to grow the rate of the stock market 7, 8, 9%. And then when I'm 59 and a half, I'm going to pull that money out, and it's all getting taxed as ordinary income. Believe it or not, when you pull out your 401ks, it gets taxed as ordinary income.
All of it sounds like a bad idea to me. Why am I like one of the few people?
That's why I don't invest in like 401ks anymore. I would rather negative cash flow on a real estate asset.
Right.
Or I'm 59 and a half.
Right.
So if you're going to be savvy enough, and don't get me wrong, like 401ks are great. IRAs are great. If you got the money, put it in there. But if you're willing to accept and listen to people that say, hey, negative cash flow on an IRA or 401k, why would you not on real estate that is going to grow at twice the rate of an IRA or 401k? Why is it growing at twice the rate? Because you're using leverage.
Yeah, it always reminds me of I love when people come and they're like, I want to buy a house. And first, I'm going to talk to my financial planner. I'm like,
yeah, no, I mean, and that's fine, but I like to make that a 3-way conversation. So it's me, the client, and the financial advisor on the phone. And by the time you're done with that conversation, you now got 2 clients, because now that financial advisor.
That financial advisor is asking you to help them. I'm always like.
I'm saying it because it's true. Every financial advisor I've had a phone call with has become a client. Every CPA I've had a conversation with becomes a client. My CPA looked at my tax returns for the last 5 years and he said, Patrick, I'm going to invest in real estate. And he didn't care about cash flow or not. I'm telling you, become much wealthier off of getting your return from that appreciation, the growth, over the cash flow. But that's like a whole class with Excel spreadsheets. We can jump into that.
I'm excited because I definitely want you to co-host these. We've Tristan and Lab Coats. We want to do the investment series, but there's so much to learn here. So we're gonna definitely launch it as like a class format. That would be super cool to break up the topics and to, do it consistently through LCA.
Absolutely. And Vanessa, I'm so confident in what I teach and preach that I tell all my clients, and I tell them I'll put it in writing, and here you got it recorded. If you become my client and you do what I tell you to do, and you're not a millionaire within 20 years, I will write you a check for the difference. I guarantee you I'll write you the check. You got to do what I tell you to, though. And so many agents think our job is to like be what we call order takers, take orders from your client. I tell all my clients.
I'm not a Vanna White agent. Do you like house A or do you like, no.
I always tell my clients at the end of the day, the ultimate decisions are up to you, the client. But my job is to advise you and tell you what you should and shouldn't do.
I say the same thing. I'm like, what you'll hear from me is when I give you advice and you decide you want to go in a different direction, roger that. Yeah. All right, we'll do what you want to do. And otherwise, but my clients are like, Vanessa, I want to go buy this. Is this okay right now? Sometimes I'm like, you have freedom. Go ahead and buy things right now. But I think I got my best post. You're going to laugh. On Mother's Day, I got a text from one of my clients and he said, Happy Mother's Day, real estate mom.
There you go. There you go, Vanessa.
I was like, okay, I'll take it.
Vanessa,
Patrick,
one thing I brought up a couple of times is that the wealthiest families in America don't invest for cash flow. They invest for appreciation. And the biggest example of that is artwork. So look at artwork. Why do you think wealthy Americans will go out and buy a $2 or $3 million piece of artwork and then just put it in a safe? Why do they do that? Because artwork is not going to pay cash flow. Not less than even a no cash flow real estate. Artwork doesn't pay cash flow, but it appreciates. So an investor will go out and buy a $2 million Picasso. They'll wait years, let that Picasso be worth $3 million, sell it, make $1 million profit, and roll that profit into a $4 or $5 million Da Vinci, right? I'm not an artwork investor, so I don't know what these artworks are worth, but they do that because that money they made $1 million on the Picasso, it's all tax-free money because they do a 1031 into the Leonardo. And what I just said was a true statement up until 2019. And then with the new tax law, the 1031 exchange, which you could 1031 artwork, folks, believe it or not, you could 1031 anything, including artwork, classic cars. 1031 exchange went away for everything except real estate. Real estate is now the only entity that you can still 1031. So your wealthy Americans will go out, they'll buy assets that don't cash flow but appreciate and don't get taxed. During that appreciation cycle, they sell it and roll that appreciation into the next asset to just continuously grow their wealth. And that's, you can be a millionaire off the stock market, but you're never going to be a decamillionaire worth 10 million or more. You can easily become a decamillionaire if you start investing in real estate in your 20s or 30s. Easy. That's really what I push to my clients. And I tell you, my job is not to make millionaires. It's to make multimillionaires. And so is your job.
That's right. Amen.
But yeah, unfortunately, that's why a lot of the art auction houses shut down within the last year or two, because the 1031 exchange went away for artwork. And that's why people that would buy artwork and then
it's almost like that's where a lot of people can shelter some extra money.
What's that?
Right? That's where people can shelter some extra money.
In artwork, and you can make tax-free growth, but you can't 1031 artwork anymore. You can't 1031 classic cars anymore. You can't 1031 anything except real estate. So when that tax law got passed, I'm telling you, real estate should have had a bump in prices due to tax.
Now the wealthy have to put their money somewhere.
Yeah. And it didn't, because 99% of real estate, of people in our business and investors worth millions of dollars, don't understand real estate tax law. I have worked with investors worth 4 million, worth 5 million, worth 6 million, and they don't understand real estate tax law.
Well, and even when we deal with some of our wealthiest clients, like my client's busy being a neurosurgeon. He doesn't want to learn tax law.
He's not going to.
That's
too
why
busy
he
doing
needs
surgery.
to rely on. Yeah. So they want to rely on the professionals, and that's where our skill, our knowledge is really where we have to increase our ability, because that's where you're going to have like the edge when it comes to your ability to be the expert, and who people trust is when you know how to help them.
Absolutely. We are not salespeople. I've said it again. I'll say it before. Like, we are not salespeople. We're educators. And if that's the way you look at your profession as a realtor, you will be successful. You need to educate. And before you educate, you got to educate yourself. That's the most important person. Educate yourself so you can share it.
Yep. Absolutely.
I'll send you the name of that tax book.
That what?
I'm going to send you the name of the tax book so you can now read it too as you go to bed.
Oh, yes. Yes. Oh, yeah. I'm going to read it when, Brad needs it. I said he was up. You need to send it to him. Read this when you're not feeling like you can sleep. It's funny.
I'll tell you what, too, the more you learn, the more you know you don't know. And the more you learn, you need to learn.
Well, learning is so infinite. I mean, It's like, and you just have to eat a piece of humble pie and lean right in.
Absolutely. Absolutely.
Thank you so much. And we will set up a time so that I want us to market it with an LCA. So I'm going to hit up our leadership and we'll get this on the calendar. If this time, consistently works for you, let me know so we can let our listeners know and we can set it up.
Okay. Yeah. Let's discuss that. Wednesdays, I do, like I said, I think I got 4 of these today. Some of them are like team meetings. I got a webinar tonight at 6:30, but we'll find a time where we can consistently set it up.
Perfect.
Cool.
All right. I will talk to you soon. Thanks, friend.
All right,
Awesome,
Vanessa, thank you for having me on, and enjoy the rest of your day in Alaska. It looks sunny.
Sorry.